Well, good morning. Welcome back to the broadcast, Retirement Network. I'm Jeff Snyder. This is BRN AM for Thursday, August 4th, 2022. And our top story today, the Fed hikes interest rates, but what's it mean for you? Well, joining me now to discuss this and a lot more, Karishma Vanjani is a journalist with Barron's. Karishma, so great to see you. Thanks so much for joining us on the program this morning.
Thank you so much for inviting me.
Yeah, this is great, and this is a perfect follow-up. So last week, I think the Federal Reserve Board announced an interest rate increase. So a lot of people are asking, well, how does this interest rate hike, what does this mean for average consumers? And I know you did a piece, one of your many pieces in Barron. So what does this mean for consumers? If everyday shoppers, people out there, see this hike, what does this mean?
Sure. So the idea behind the story was that my roommate asked me, oh, Fed is increasing rates, but how does that affect me, right? So I was like, wait, it does affect you. It affects all of us. Because what happens is that people look at it at the upper level, because this is a benchmark rate. It's happening here. Does it really impact us here? Some people think that, oh, the Fed rate hike means my bank interest rate hikes up, which is sort of true, but it's an indirect relationship. And I think that's really important to remember. So the way the Fed rate hike works is that when Fed increases its rate, it sort of has an indirect impact on the prime rate. And now prime rate is the one that credit card issuers are sort of basing their rates on. So they charge prime rate plus about 3 percentage points. So the prime rate increases because of the benchmark rate. Then prime rate plus 3 percentage points, it all goes to the consumer. So your credit card rate increases. Not just that, it also has an impact on auto car loans. If you go out to buy a car right now, expect a higher interest rate on that. Mortgages work a little differently. The adjusted mortgage rate would be impacted, whereas the fixed mortgage rate will also have an impact, but a lesser one.
Yeah, really good information. I want to unpack this. I want to talk about credit card and credit card debt in the second segment, because I think that's a topic. So many Americans, I think there's $1.6 trillion in student loan debt, but credit card debt's even higher. But let's just talk a little bit about, you mentioned interest rates for a checking account or a savings account. Now, those have been notoriously low, right? I mean, those have been very low for so long. And so a lot of people keeping money in a bank account may not get very much interest. Is now the time to shop around? Like, say you're banking with company X, should you look at company Y, or maybe even look online to some of these other banks to see what the rates might be?
Yeah, so that's a great question. So what we must remember is that, yes, we can shop around. There are credit unions that offer credit cards with a cap of 18%. But all in all, you will see higher rates irrespective. The average right now is about 17.35%. That's so much higher than what we started this year. We started this year with a 16.3%. Now that's the average, which basically means that if you pool a bunch of credit cards somewhere around 100 and you take an average of all the APRs or the annual percentage rate that they're all offering, that has ticked up, which basically means that, yes, you can go around, try to shop. But if the average is high, most of the credit cards that you're seeing out there will offer you higher interest rate if you don't pay out your debt. So one great sort of takeaway from this is that try to pay your balance in full if you can.
Yeah, absolutely. I mean, I think that is to stop things from getting out of control, whether the interest rate is 0 or 17%, it's always best to do your best to constrict your shopping and also pay off your balance. But the cost of borrowing, let's just take an automotive loan. First of all, Karishma, the cost of a new car going up through the roof, right? So on top of that car, you're going to pay at or above sticker, at least, and get your opinion on this, but you talk to Consumer Reports or AAA or some of these other automotive brands, you're going to pay way more. Now on top of that, the cost to borrow may go up because of interest rates. That's really putting a lot of pressure on the average consumer, on top of gas prices and food prices.
Yeah, no, you're completely right. There's a lot of pressure on the consumer. The part of the reason why car prices are high is because of supply chain stuff, right? You don't have car parts reaching at the right time. So things are very different from what they used to be in pre-pandemic. So the auto loan rate, if you want to talk about that, then if I'm going outside to go buy a car, I would probably see an average rate of almost about 5%. And an interesting data point here is that the record price or the record auto loan rate that we've seen is 5.3%. That was at the beginning of 2012. So we are really approaching that number very quickly here. Again, that's in a way because of the trickle down effect of the Fed's rate hike. The good part about the Fed rate hike here is that the intention here is to get the inflation under control. So it can possibly in one way mean that all of the impacts that we're seeing of high interest rate could be transitory in some way.
Yeah, and look, that at the end of the day, consumers are getting it we're all getting it from both ends, right? The cost to borrow is going up, but then the cost to go to a nice restaurant or the cost to even feed a family of four by going to the grocery store, that premium, there's a premium for gas, that's going up. So and you mentioned supply chain. Last question before we go to commercial, and you made reference to mortgage rates. I know there's not a direct correlation between what the Fed does and mortgage rates, but it does seem like the mortgage rates, after a little bit of an ebb, have continued to go up and continue to spike, maybe more than what people has seen. What's the impact to mortgage rates overall?
Sure. So mortgage rates really come in two flavors here. One is adjustable rate and one is the 30-year fixed rate that people know more about. The adjustable rate is more likely, so you go ahead and get a house, interest rate will be locked in for 10 years. And then for the next part of the remaining term loan, you'll have to sort of pay whatever the current rate is for that. So that has been the one that has been impacted more than the 30-year fixed, because 30-year fixed is it's fixed for whatever time that you're getting it. And so the adjustable rate that was before the Fed increased rate last week in Wednesday was at 5.07%. And that's still, and the fixed rate was 5.67%. Now, the highest fixed rate that we've had on the 30-year mortgage loan has been 5.9%. Again, that's another part of the economy that's coming close to the record high. So yeah, as we discussed, consumer is being pressured. It's very hard for me to go buy a house right now. If I could, I wouldn't at this time. So that's where we are. I was talking to my sources about some of those that are trying to buy houses, and one of them went ahead and put down a down payment in December. His point was that, maybe inflation will pass, maybe rates won't be high, because that was sort of the stance of the Federal Reserve last year. They were really they were really talking about how there won't be a need to raise interest rate, and high prices would be transitory. Of course, that stance has changed as things have changed, and that source right now is trying to lock in a better rate at 3.6%. But of course, it's going to be hard for him to do that.
Yeah, I mean, look, the Fed, obviously their language, everyone watches the language. I think more people spend time looking at the Fed, the chairman's body language, and also what he says to try to decouple and understand. But clearly interest rates are on the rise, mortgage rates are on the rise. We're going to see more of an impact on housing and other cost of borrowing. Karishma, I need to take a very quick break. When we come back, we'll talk about credit cards, your credit card debt, and managing that, and interest rates. You're going to want to stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms? Especially for the smaller businesses. I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get in.
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network.
Are you stuck with a low credit score? A credit report and score that's causing you to be denied credit or pay higher interest rates than others for the same things? Then do what Terrence did and call Credit Repaired for your free credit evaluation to help restore your credit.
I started thinking about buying a new house, and my score wasn't where I needed it to be. I called and spoke with one of the representatives, and we just had a good conversation, and I liked what he was saying.
Just one call for his free credit evaluation was all it took to start back on the track to repairing his credit.
I'm seeing the deletions and I'm getting the report, so I know something's being done. It does make a difference to me.
All it takes is one call to get started.
Credit Repair has given me a second chance to have a better credit score.
Don't let a low credit score hold you back another day. Do what Terrence did and make the call for your free credit evaluation.
Call 800-819-4152. That's 800-819-4152. Again, 800-819-4152.
Welcome back. We're talking this morning to Karishma Vanjani. She is a journalist with Barron's. Karishma, thanks so much for sticking with us this morning.
Thank you so much for inviting me here.
Yeah, I'm so glad that the interest rate talk didn't chase you off. No, I'm just kidding. Let's talk about credit cards, because for a while during the pandemic, I just want to paint a picture here. For a while during the pandemic, people were paying off their credit card. People weren't spending as much money. It was almost like people heeded all the things that we talk about in the retirement industry, which is save money, save money, save money, paying down that debt. Now you look post-pandemic, you look now, people are actually spending more money. Credit card debt is going up. What are your thoughts about that?
So, well, I think the part that we all should pay special interest here, or attention here, to, is lower income consumers. The second they start defaulting on their rates, that's when we know that we are in a big problem, because their sort of interest rates, or the APR, is more likely higher than the average one. So right now we are at about 17.35%. That's an average. Expect that for a lower income consumer with a not so great credit profile to have a higher than 17.35%. So when they start defaulting, that's when we know that we are in trouble, and we can sort of expect a higher wave of defaults going from there. Good part to remember, in recent sort of earnings with JP Morgan and Wells Fargo, they have sort of pointed to the lower income consumers, but again, the default rate stands very low. And with JP Morgan, one good thing to remember, they are mostly a credit card, their credit cards are more their credit cards is more for the wealthy consumer, if I can say that. Or rather for the consumer which can sort of in one way afford it. Because if you go to see with Chase, the Sapphire Preferred, the last I checked had a $95 annual maintenance fee. So that's one way to see it, as, okay, when these guys point out the lower consumer, they don't have so much of an exposure to a lower income consumer. But, even them saying that, let's pay attention, the default rates are ticking up, but just by a slight amount, it's something that we should pay attention to.
Yeah, and so interest rates on these cards, they're already high. They're going up. Let's just remind the audience that paying the minimum, that is the minimum that they show in your statement, whether your digital statement now, because they don't even mail statements anymore. But if you pay the minimum, you're basically just paying into the interest. You're not paying the principal. That's probably not a great rule of thumb, right? I mean, you want to, in a time of rising rates, you want to make sure that you are paying as much of your balance as you can on one side, and on the flip side, don't spend as much money if you can avoid it.
Yeah, but that's easier said than done, right?
It is. And I'm being very general here, but you're right. It's easier said than done. I get it.
It is definitely easier said than done. But let me give you a very sort of eye-popping number here that my source told me. Given the current sort of over 17% interest rate on credit cards on average, if you go ahead and take a $5,000 balance and you only pay your minimum payments, nothing more, you would need 187 months. That's, I think, from my calculation, about 15 years to pay it off. And that on that 5,000 balance, you have 5,872 interest. So that's like more than the balance. It's what you've paid in interest in all this time. That's if you go ahead and pay the minimum balance. And that's to your point of how paying minimum balance can sort of hurt you. And it's just not enough. So of course, paying your balance in full is great. Another option here is the 0% balance transfer card. There are a lot of companies out there that are offering, for you to transfer your balance from one card to another at a 0% fee. But again, the caveat here with that is that you shouldn't constantly keep on doing that, because you'll then just be in a loop of where you're just constantly transferring your balance to 0% fee all the time and never really paying it off.
And it really hurts your credit score, right? Because you're diluting the tenure of credit that you have. So that's probably not a great approach either. I mean, look, it's easier said than done. A lot of people are facing very difficult times. Do you think we do a good job? My last question, and this is kind of a softball, but I want to get your opinion on this because you cover things like banking and interest rates. Do we do a good job educating our fellow citizens, educating people about credit card debt, managing their finances? It's pretty easy to get a credit card these days. Anybody and their mother can walk out, get a credit card. You could have a 400 score. You could have no credit score, right? You could have no history and still get a credit card. Do we do a good job, and can we do better in terms of educating people about some of the things we just talked about?
I think I'm going to double down on your point around how easy it is to get credit. You can just walk in and get a credit card, and even if you make some amount of payments in the next few months, your credit limit will increase. It's, again, because it's not very difficult to get a credit card, it's not very difficult to be in debt. And that's, if I have to go really macro on this, I want to say that's something that's very US specific. When you look at developing countries, the idea of being on debt is not so common. And just to sort of take a step back here, if you go to India, the idea of credit cards aren't so common. And that's partly because, credit is not so easily available. So it's both, it's a double-sided sword here. Credit being easily available is a good thing for the economy, right? Like, people are able to spend then. But again, you get debt. People that probably can't pay but are constantly sort of spending their money. Do we do a good job of educating our consumers or people about paying off the debt? Well, I think we're trying to do it, because there are sort of, when you do get your statement, you will see sort of the remarks as to, okay, this is what has happened to your credit score. This is what you can do. And there are sort of ways that one can learn more about it. But at the same time, just the whole idea about how easily the credit is available, you sort of get swamped in it. There are new credit card companies coming, now and then, that sort of offer you different ways to sort of get onto their plan and in a way pay off your credit cards. But that again it's in a way putting you more under that, because if you go to see, there are credit cards out there, they'll offer you a chance to sort of get on their line, and they will sort of combine all your credit cards. So if I have a Chase, if I have a Wells Fargo, if I have an American Express, there's a company out there that'll take all of that, put it under one line, and will pay off minimum payments. But again, you got to see what's the sort of black and white story here, what's there in the fine print. So it's important to see those things while, because credit is available so easily, don't just go ahead and take the next credit card that offers you a $200 reward. I'm embarrassed to admit, but that's something that I did earlier. I was like, okay, this is giving me $200. I need that specific dress. It'll be helpful to get the free $200. But then, at the end of the day, you just have more things to keep track of. And just given, how busy we can get, it can get difficult to sort of keep track of 5 credit cards with different minimum payment due dates.
Yeah, well, I could tell you in the mail every day, my wife and I get 3, 4, or 5 credit card offers. And let me tell you, this is out to the credit card companies. We don't need any more credit cards. I don't. Jody, my wife, doesn't. Please don't send them. Don't waste your postage. Karishma Vanjani, so great to see you. Thanks so much for joining us. And we look forward to having you back on the program again very soon.
Well, lovely talking with you, Jeffrey.
And that wraps up this episode of BRN AM. Have a topic of interest, someone you think we should talk to, drop us a line. And don't forget, for all the latest curated news in lifestyle, wellness, finance, tech, so much more, and all in one place, check out today's edition of our daily newsletter, The Morning Pulse. Want to search our archives, check out our latest content? Well, visit our website and our streaming partners. We're back again tomorrow for another edition of BRN AM. Until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.
Waiting here for you to take and drink of. But if you're tired,
Now is your opportunity to co-create content around any topic on the first lifestyle and wellness network. Reach a global audience through our platform and co-own exclusive branded content. All of our programs are available on demand and also as audio-only podcasts, so you can take us on the go. Broadcast Retirement Network, available anytime, anywhere, and on any device.